Today's presenters are Chris Lee, VP of Transformation and Innovation at Xactly, Danny Veksler, Managing Director with KPMG, and Jen Sickman, Manager of Transformation Consulting at Xactly. As the head of Transformation and Innovation at Xactly, Chris gets to marry his passion for advising customers on how they can drive transformational change across their revenue organization with identifying industry-leading technology-based innovations that can enable unique business outcomes for customers. Danny Veksler is a strategy and technology executive with a distinguished track record leading transformation programs and advising companies to achieve top-line growth and operational excellence. From technology startups to the world's largest and most prominent companies, Danny has led large, diverse, and high-performing teams across the globe to generate billions in value realization for his clients, orchestrating progressive techniques to enhance the performance of people, process, and technologies in order to transform organizations, companies, and industries is at the center of Danny's tireless professional drive. Jen Sickman leads Xactly's advisory practice, Transform, and supports strategic organizations in planning and executing revenue transformations. At this time, I would like to turn over the floor to Jen Sickman. Jen, welcome. Oop, you are on mute.
Sorry, everybody. Thanks so much for having us. Again, very excited because this topic is coming up more and more for all of our clients. And really, to kind of tee things up, companies right now are operating in a dynamic and evolving market that continues to defy economists' forecasts and expectations. And what we know is that volatile markets have a significant impact on businesses that aren't built to last. Because revenue is the fuel for an organization, it's the logical place to start when assessing the strength of an organization's ability to stand the test of time. And what we found is that, through research, only 7% of organizations believe their existing operating model can adapt to changing market conditions. So in other words, most businesses fear that they don't have the right people, processes, and technology in place to operate at speed. And along with that, only 15% of organizations have been able to grow both revenue and profit over time. And typically, an organization will reinvest their profits into the business to drive innovation and market expansion. So the absence of profits prevents an organization from investing in the future. And finally, only 6% of revenue leaders are confident in their team's ability to meet or exceed revenue targets. This is a huge concern because businesses that don't trust their performance or their growth engines will spend the majority of their time analyzing and dissecting their pipeline at the expense of actually growing and securing revenue. Businesses that acknowledge and address these fundamental issues will be in the best position to thrive. And so, Chris, I'd really like to open this up to you. What trends are you seeing in response to changing market conditions? And what are the implications for business leaders?
Yeah, for sure. Thanks, Jen. So I think everyone knows this by now, but when the pandemic hit, pretty much every organization needed to fundamentally change their go-to-market operating model. And so we saw this wave of digital transformation as organizations change the way that they interact with their customers, going from a primarily in-person model to one that is almost exclusively virtual and remote in nature, right? And so with that, organizations realized that they were being highly reactive and that this market disruption, it's probably here to stay. So we saw this heightened desire for organizations to drive agility throughout their business so that they could continue to be proactive as they move forward. And kind of just as they were getting, their bearings on this and making sense of the disruption, sure enough, the economic downturn hit and the investment community pretty much overnight changed the way that they value organizations. So gone are the days where you can just kind of grow at all costs and you're rewarded handsomely for that. Now you have to strike this balance between, predictable growth and sustainable profitability, which is obviously very difficult to do. And so organizations now are trying to figure out, well, how do I evolve my business model in order to strike that balance? And so the positive thing, though, is compensation is a great tool to be able to do that. The key, though, is that the deployment of the compensation program needs to be deployed correctly in order to realize that balance. So, Danny, I know that your organization obviously has helped many companies navigate these difficult times. So, kind of interested in what your perspective is, related to this macro view that we've got.
Yeah, thanks, Chris. I heard a saying once about change that really resonated with me, and it went something like this: the pace of change will never again be as slow as it is today. We fret about an economic recession or what happened with COVID or some of the bull markets that we just came out of and in adapting. But the reality is that adaptation needs to be the norm. And it presents us with a conundrum in the way that we think about each of our respective roles in a go-to-market context. In 2019, I started working with a 125-year-old manufacturer of products and services that support moments that matter, particularly in the educational space. Think about products like yearbooks and grad regalia, class rings, etc. And the company had recently come under private equity ownership, and I was responsible for realizing the growth aspects of the investment thesis. Their go-to-market was primarily through independent agents aligned by geo. And one of the things that became very apparent early on in some of our analysis was that they had tremendous pricing autonomy, and the sales team was driving a meaningful gap in top and bottom line performance on the order of tens of millions of dollars. When you looked at the distribution of performance across all of the different sellers, you quickly realized that in the top decile, sellers were realizing 98% of list price across their portfolio of customers. Mid performers were capturing about 82% of list price across their respective portfolios. And on the low end, the low performers were realizing less than 70% of list price. So what we did is we rallied around 3 pilots of almost as identical sales cohorts as we could get. The first was really geared toward learning and development design changes and making sure to take the stories of top performers and how they're achieving list and distribute that across kind of the mid and low performing cohorts. The second pilot was really focused on incentive design changes. And at the highest level, we decelerated commission rates the bigger your discount got, and we accelerated commission rates at and above list. And then the third cohort was really a hybrid of both the L&D initiatives as well as the incentive design changes. We also had a fourth cohort that was really used as a control. We very quickly and within weeks realized a multi-million-dollar uplift in price realization, which we then reinvested in enhanced digital capabilities across CRM, CPQ, sales comp, and new marketing and commerce capabilities. Remember, I said I started this role in 2019, and in March 2020, the world changed. For this organization, its entire go-to-market was through schools, using paper order forms that all of a sudden were no longer open. They couldn't go into the schools. That's all they ever knew about their sales motion. And our digital transformation obviously could have never anticipated COVID, but the investment into the digital commerce capabilities created massive differentiation in this marketplace, because they were really the only player in this niche category that was effectively able to pivot to a fully digital marketplace to support the business. And with the right incentives and the right L&D, we were able to really accelerate the adoption around these digital investments that we had made. And what ended up happening was, in an industry that had seen very little changes in market share in decades, all of a sudden saw a massive swing in market share toward this company because of their continued investment into these capabilities. And it supported them moving into the dynamic environment that we all now know is the new normal. And as leaders, I think it's really important that, we think beyond today's challenges and really invest in resilient go-to-market operating models and digital capabilities so that we can adapt to tomorrow's challenges. Even if we can't anticipate them, we know they're coming. And I think it's the key to winning in this highly, highly competitive market that we all operate in. Jen, back to you.
That was great. And I feel like the example you used and this theme of, adaptation needs to be the norm. We need to meet the moment, but we also need to plan for the future through smart strategies. I'd love to bring it back to, compensation, right? In terms of those strategies for a downturn. And Chris, against this backdrop of uncertainty, what playbook can revenue leaders leverage to chart the path forward for their organizations? And how should incentive compensation programs be at the core of that strategy?
Yeah, so as I mentioned before, I think it's clear that compensation is an effective tool to drive change, to combat changes in market conditions. And so typically what we see in an economic downturn is buying organizations will slow their pace of purchasing from net new vendors. And so organizations should be acknowledging that and focus on their existing customer base, right? So they can increase their focus on upsell and cross-sell within their customer base. Now, naturally, in order for that to be effective, an organization needs to rethink their coverage model and, of course, needs to use incentives effectively to focus their resources maybe away from new business to their existing customer base. Now, the positive thing here, though, is from a profitability standpoint, generally speaking, it's much more cost effective to sell to your existing customers versus selling into net new customers, right? The other thing we typically see is the reality is no one really knows how long these downturns are going to last, right? And so prudent organizations will actually focus on long-term revenue streams, right? So another strategy that we see implemented is organizations encouraging and then rewarding effectively the sellers to focus on selling multi-year contracts, and typically the longer the better, as well as those contracts that have price increases baked into them. And again, the magnitude of the price increase, the larger, the better. And from a plan design standpoint, generally speaking, what we see is organizations will use what we call kickers in order to incentivize this type of behavior. Well, they'll add specific percentage points based on the magnitude of the duration of the contract, as well as the size of the price increases that have been baked into the deals. So effectively, the organization's kind of paying now for that long-term, revenue predictability and sustainability. And then the third thing we see is usually at some point throughout the life cycle of a downturn, an organization will go through some sort of resource rationalization, right? And typically the leadership team will come to the go-to-market team and say, listen, guys, we need you to all act as owners. We need you guys to double down, lean in, drive accountability, and really own your purview of responsibility. But with that increased focus should come reward, right? And so typically organizations will do that by way of what we refer to as steepening the pay curve, meaning at some point in the attainment of their quota, organizations will really incentivize organizations to kind of go above and beyond. They want to incentivize those top performers. They want them to overachieve because they're trying to maximize the productivity that they can realize from what would otherwise be like finite capacity. So those are three strategies that we typically see employed during these times. Now, Danny, I know that you have a practice that obviously helps organizations optimize their compensation programs. So kind of interested in hearing what have you seen deployed in the field to combat these times?
Thanks, Chris. a hot topic is an understatement at this time on this topic. You know, there's been an interesting shift in the type of conversations that have cropped up over the last 12 to 18 months regarding variable comp. Companies are dealing with wage and labor inflation, talent wars, and really hefty pricing pressure. So in the vast majority of organizations that are using a cost plus model for their pricing, you know, all of a sudden you've got these competing influences that are resulting in this common question in the market. How can I create opportunities for my people to make market competitive incomes without taking on extra liabilities on my balance sheet and still, you know, be competitive from a pricing standpoint? And the obvious answer is pay for performance, which is a practice that's been around forever, but now it's really starting to be applied in a variety of new contexts that are supporting new outcomes. So, you know, one recent example that I have is with an industrial manufacturing client. And for this client, you know, the CEO recognized that their focus needs to be around expanding market share across their large enterprise market segment. And the challenge for them was it required greater collaboration on these global deals across both the front office and the back office. They're dealing with supply chain issues, distribution challenges, and at the same time, you know, sellers were really incentivized to just get to the order and hand the process off. And so there wasn't this kind of connected focus around customer outcomes. And in this particular market segment had the highest expectations around what they expected to get in terms of products and services, because they had the, you know, the purchasing power to be relevant in that capacity. So what they ultimately wanted to do was, you know, create compensation programs that enabled split crediting both regionally and globally, and offer employees upside only when they deliver on maximizing share of all wallet within this market segment. And it required greater collaboration with the seller and the back office supply chain folks and the distribution folks in really a global capacity. And so, you know, pay for performance is no longer something that's isolated to just a sales environment, but it offers organizations the ability to offer their employees greater upside, while at the same time, you know, coming in and delivering on the strategy of the organization more effectively. And the extraordinary thing that has also come out of this is that for teams that have, you know, played a big role in administering comp and supported kind of the operations around, you know, the front office, all of a sudden they're moving up the value chain, they're collaborating in a cross-functional manner, and they're playing a much more strategic role within an organization, which is creating upside opportunities that would otherwise never be available to them in working in a traditional cost center. And so compensation is being, you know, applied in ways that we've never really seen before, variable comp, and it's helping companies that are innovating in the way that they think about their human capital management, an opportunity to get more cost-effective growth and greater operational efficiency, and ultimately yielding better outcomes for customers and maximizing that customer share of wallet. So it's extraordinarily powerful, and the digital capabilities supporting it underpin your ability to be agile in deploying these types of changes as market conditions evolve. Jen, back to you.
That was great. Thank you, Chris and Danny. And I think as we build on, you know, some of those pressures that, you know, were mentioned in the competing influences to really drive an outcomes-based approach to compensation, you know, there is another kind of shift happening with revenue organizations that we're kind of overlaying on top of this trend, which is the shift from disparate and siloed revenue support and generation functions to a more unified revenue operations model. And so, Chris, with this new shift and this movement, how is it a sea change for organizations, and how can leaders navigate this effectively in a downturn?
Yeah, for sure. So as I've said a couple of times now, I think deploying an effective compensation program can help organizations navigate these times. But the reality is deploying an effective compensation program is actually really difficult to do. And the reality is many organizations fail to realize the effectiveness that they expect by having deployed that compensation program to begin with. And one of the common things that we realized for why that's the reality is organizations neglect to integrate their core compensation process with the upstream and downstream business processes that kind of make up the revenue operations lifecycle as it exists today. And so naturally, having helped thousands of organizations over the years optimize their compensation program, we've worked collaboratively with them to define what we believe is the best-in-class approach to maximizing the potential yield of a compensation program. And we call it the agile go-to-market process. It's really pretty simple. There's 3 phases to it: plan, perform, predict. You can see that it's cyclical in nature, so it kind of never stops, just ongoing and continuous. It starts with an organization establishing, what are my targets? What should my coverage model be? How should I think about capacity? How do I carve my territories, allocate my quotas, establish the mechanics of my comp plans, ideally employing some of the strategies that we talked about before. And ultimately, what are the expected economics of my go-to-market operating model? Right. So that's the plan phase. Organizations will package that up and operationalize it. And then they're executing upon the sales strategy. Right. So here they're managing their pipeline. Ideally, they're closing deals. And of course, they're compensating effectively their sales organization for the success that they're bringing to the business. And they're even understanding the expense implication of that success so that, again, they can strike that balance between growth and profitability that's so important in today's, macroeconomic situation. But it doesn't stop there, right? So because of all of this uncertainty, because there's this acknowledgement that change is inevitable, organizations are now becoming much more forward-looking, and they're trying to predict what's likely to occur in the short, medium, and long term, right? But they're no longer just forecasting their top line, right? Because growth isn't the only thing that matters. Now they also need to be able to forecast their bottom line, right? So what is the cost implication of this success that they're trying to drive? And what this affords them is the latitude in the event that the outlook isn't exactly what they would want. They can course correct in real time. And that's where they might then go back into replanning mode, and hence the cyclical nature to the process. And so we see this kind of interconnected series of business processes surrounding the core compensation process and fostering collaboration across all of the stakeholders that naturally manage these business processes as the ways that organizations can truly unlock the value of their compensation program. So Danny, I know, again, you guys help a lot of organizations with Salesforce effectiveness. So what's your take on this very holistic end-to-end model?
I'm a big believer that executives need to take a hypothesis-driven approach when it comes to planning for the future. And I'm working with a top 5 financial services firm in Canada that's really taking an aggressive and innovative approach to how they're looking to navigate this macroeconomic environment that we're wading into. They've built a hypothesis that their biggest market opportunity is by farming their core, customer base and really helping to drive cross-sale growth across both their wealth management and insurance products. And what they've recognized in their indirect channel through their independent agents is that they tend to have really strong customer affinity, but it exists within either their wealth product set or their insurance product set, but not across both. And there are a variety of reasons for that. The biggest of which is you need to be cross-licensed to be able to sell across both, or you need to be willing to hand your customer off to and be a lead generator for another agent that is, cross-licensed in the other product set to be able to support this. Now, they've gone through the planning and forecasting process, and they came up with a new plan design. They understand kind of where and how they're planning, how they're gonna build in the right compensation opportunities in order to shift the sales motion so that they can effectively farm the core and get this cross-sell revenue. But they also are self-aware enough to understand that these are all hypotheses at this point. And they need to have the right insights to be able to see whether their comp is effective and whether it's yielding the right sales motions in order to maximize the opportunity around this cross-sell. So they're not only deploying, the compensation changes, they're making sure they have the right diagnostics and insights that allow them to tune the model as they go into this next performance period. And they're going to be, really able to hyper tune on a monthly basis based on the things that they're finding and what's working. And that goes beyond comp. That could be related to competency development. That could be related to, the way that they allocate and move territories and quotas and targets, and comp as well. And by leveraging kind of this cross-functional support to ensure that all the go-to-market functions are clear about their swim lanes, it's going to enable this continuous improvement and ideation process to, really mitigate the risks associated with, their biggest concerns, which is sellers are going to revolt. This is one of the biggest changes they've ever asked their sellers to make. And the majority of them are independent. And so there's always the risk that they just say, the heck with it. I'm going to go and start focusing on selling some of your competitors' products. And so by measuring the effectiveness, they're able to know what's working, what's not, and they're going to, put themselves in a position to ideate quickly in order to make sure that these changes land impactfully and that their forecasts where they predicted meaningful growth through this shift in strategy is far more likely to be realized. And unfortunately, this is more of a unicorn story because I can't tell you how many client conversations I've had where an organization is taking a bet the farm strategy on something entirely new without investing in the capabilities that allow them to ideate, because we know that as good as we might be at forecasting, there are going to be unanticipated challenges that we're going to face. And without the process to be able to do that, you're far less likely to actually hit the targets you're trying to realize. Jen, back to you.
I feel like that was so compelling, right? In terms of, the insights Chris and Danny just shared. And as we think about, driving a more holistic approach to an agile go-to-market process and bringing in those insights and investing in the right capabilities, building the right hypotheses and substantiating it, we find that tech debt is becoming an ever increasing liability and barrier to driving business resiliency. And just a little bit more on this background, right? So 84% of growth strategy leaders have identified that adapting incentives at the speed of market change is important or very important. Yet 50% of homegrown or spreadsheet calculation mechanisms take 4 or more weeks to pay out. So there's clearly dissonance there. And this is just really one example of how manual processes and tech debt prevent organizations from responding to changing market conditions and really driving that holistic approach to agile processes. This is against kind of, the background and the literature proving, though, that when you're trying to modernize and drive business outcomes through a realignment of technology, we really require transformation planning. Companies that are successful in planning effectively are 5 times more likely to exceed expectations from their technology projects. So ultimately, Chris, would love to hear your thoughts on the role of technology in compensation process and really the need for digital transformation planning.
Yeah, for sure. I mean, I'm sure it's obvious that leveraging technology to enable the compensation program can yield positive outcomes. The reality, and the scary reality, is that if technology is deployed on its own in a vacuum, in a kind of set it and forget it type of mode, it typically doesn't drive any change. If anything, it drives negative change, right? And that's really where transformation planning comes into play, where transformation planning is all about defining the desired business outcomes of the organization, right? Mapping them to the broader macro strategic priorities of the organization, and then really figuring out, what do I need from my people? How do I need to augment my processes? And how am I going to put the technology to use? And more importantly, how are those 3 areas going to work together in order to truly realize those desired business outcomes? But that's easier said than done, right? It's a challenging thing to do effectively. And so we created a maturity model to actually objectively help organizations assess the current capabilities of their people, their process, and their technology, and help them map out what an ideal future state could look like to chart an effective path to that ideal future state to drive those desired business outcomes. So we firmly believe that it's this combination of transformation planning and, of course, the deployment of technology that can truly unlock the value of the compensation program within the organization. So Danny, again, I'll pass it back over to you. I know that transformation planning and the deployment of technology is literally your business. And so just interested in what your take is on this.
It's funny. For the longest time, we've talked about tech debt as being a barrier, and it's this stigma in the market: tech debt. I can't overcome it. It's a huge challenge, especially when you're dealing with global 2000 companies at scale. And there's a reason it's called tech debt. When you think about debt, taking out a loan to buy a house is very different than going in and taking out a payday loan. And the way that you think about paying back your credit cards versus paying off your mortgage is very different. And organizations for so long have found it very easy to incur debt, but have struggled to, fulfill their obligations around paying it down. Meanwhile, they feel like they've got they find themselves handcuffed when they've achieved scale because of this mounting tech debt. So, I'm working with this Fortune 50 telecommunication company, and I like this example because they represent some of the biggest challenges that you can face from a transformation standpoint. They've had over 200 acquisitions over the last 10 years. And to achieve the level of sophistication and maturity that Chris and I and Jen have been talking about, for the last 35 minutes, really felt like a pipe dream. They have millions of product SKUs. A lot of them are duplicative. They actually refer to the same product in, different ways. It's super difficult to navigate. The pricing related to the same product with different names can be different, which then creates a little bit of ambiguity around, what is the actual market rate for a specific product. They've got disparate systems and data sets that they've never fully integrated because, they incurred tech debt and never really paid it back. And they've got massive scale. the path that they were looking down, I mean, really looked like walking into a haunted forest in a horror film or a Disney movie, you know, and that matter. There are too many artificial barriers to these kinds of investments that are kicking up dust and moving risk-averse executives away from the most common sense solution path, which is ask for investment, address some of these problems in a pragmatic way, and clear up your journey around driving growth. And these problems don't get easier, they get harder when you avoid them. So forcing the tech debt paydown can really help organizations address some of their largest cost liabilities and really create improved ROI around investments in the front office. And in the absence of doing something, you're really setting yourself up for disruption. And this particular company realized it. They understood it, that they needed to double down on addressing some of the front office data challenges, and they needed to leverage progressive tools, centralize and structure their go-to-market data so that they could get smarter around synergy realization across this acquisition portfolio and really set themselves up to win in a down market and capitalize on the back end of this recession within an improved market share. They are not consuming themselves with the Wall Street Journal headlines about turbulence in the economy. They're finding ways to identify tangible financial benefits to justify the transformation. They're spending in areas where the ROI is highest early on in their roadmap, and they're reinvesting the benefits that they're realizing to develop a success fund success model in the way that they fund the transformation itself. And, you know, executives will be most successful in differentiating themselves when they realize how to ask for money in a down market from the financial stewards within the organization. And the way that you get money in a down market is by leveraging these tangible financial benefits that you know you can realize against the investment, demonstrate an ROI, and then use those benefits to fund some of the more speculative, you know, opportunities, which tend to be on the growth side, in order to continue to push the roadmap and drive real and meaningful transformative change. And that becomes the key to real transformation, not just, you know, PR-based transformation, and realizing the benefits that are really outweighed for organizations that challenge themselves to think about these problems in a different way and confront the barriers that are standing in their way to getting started in the first place. Jen, back to you for a wrap up.
Perfect. Thanks so much. You know, I think you have heard a couple of themes that Danny and Chris have really highlighted, both through examples from large organizations going through this, many of your peers, as well as some of the thought leadership or the best practices that underpin both of our practices at Xactly and KPMG. So just to summarize, you know, some of those key themes, we understand that in this never normal time, this continuous disruption, organizations are having to shift their models and their revenue engines to really pave that way for long-term sustainability. Compensation, when we take a more outcomes-based approach, becomes a strategic piece of the organization in order to maximize revenue and harness the right sales behavior. We talked about this new era of revenue operations, right? And the thought process behind a more agile go-to-market process through this revenue operations model. And then finally, you know, had a pretty lively discussion around, you know, the role of technology in helping to unlock greater ROI from our compensation programs and our go-to-market strategy, as well as the digital transformation planning that's required in order to drive these outcomes across the organization. And now I think it's really my favorite part. It's where we start sort of having a more real-time conversation. And in fact, Chris and Danny and I and several of our colleagues, we spent several hours talking about this in a conference room in Denver a few months ago. And so excited to really open the floor to some questions. So I don't know, I might pass it over to you, Chris.
Just taking a look at what those questions are. So I see a few coming in.
Yeah, so I did want to ask Chris, you had mentioned that, there's a framework and a tool that our practice at Xactly leverages with clients to really assess the maturity of an organization and build that roadmap in terms of, how they can optimize their compensation processes. Can you talk a bit more about that and the success, you've seen with clients undergoing it?
Yeah, I mean, as Danny very eloquently explained, transformation is difficult, right? So there needs to be frameworks that can ground your thinking when you're trying to execute upon a massive transformation, right? And a maturity model is a nice objective framework. It's really easy to understand, but it's very, very powerful and incorporates industry best practice to effectively objectively tell an organization, here's where you are today. This is the reality. And based on what you're trying to do, here are the steps that you should take to get there, right? So it's a very easy tool to leverage in order to be able to start the thinking of this massive transformation that organizations will typically go on. So Danny, what are your thoughts around maturity models?
One of the biggest misconceptions about maturity models is wherever you find yourself today, the outcome is almost never getting to the top of the maturity model across all of the different capabilities that exist within your go-to-market. Because there are going to be elements of building the right foundation that are critical, but where do you invest in really differentiating yourself? Is it around getting more predictable with forecasting, or having the right insights around compensation effectiveness? Is it around improving your territory and coverage strategy? Because we're seeing this massive change in the talent pool, in the capabilities, and the go-to-market motions, etc. And that changes from industry to industry. It changes from company to company. And the way that you best leverage the maturity model is figuring out, similar to a craps table, where you want to make your bets. Do you want to, take the long odds on something that's high risk, high reward? Do you want to, stay and double down on bets that are going to help you reinforce the fundamentals and making sure that you have an end-to-end set of capabilities that leverage applied automation and speed up your ability to adapt to evolving market conditions? Is it about, aligning the right motivations to, shifts in enterprise strategy? It, might be the result of M&A or other things that are driving the need to invest. And so it's important to get the outside perspective, to have the structured thinking that Chris just alluded to, and apply it in a pragmatic way that allows you to start investing in, growing your maturity around those areas that you can get the most, accelerated ROI and the most tangible ROI, so that you can start to self-fund your transformation in a way that cost doesn't become a barrier to achieving results, which are absolutely realistic expectations, even in a down market.
I love it. Hey, so interestingly enough, one of the questions that just came in was, I like this idea of assessing the maturity of my company's comp process. Who can help me with that? So Jen, I'm going to pass that over to you.
Yeah, absolutely. So at Xactly, we have a complimentary advisory offering that we provide to organizations. And so our transform consultants would be happy to run you and your team through our maturity assessment. It's 15 minutes of your time, right, to take a end-to-end survey. And then we bring in kind of our expertise to do that mapping around the strategy. And I really resonate with what Danny shared, around the framework and the idea that as you are looking more strategically and assessing holistically, these become inputs for justifying the ROI of change. And we've had a lot of success, working with clients in this way. And we also are really enjoying partnering with KPMG as well.
Love it.
I think there's another question that keeps popping up as we talk about these things. And Danny, you just, again, I think knocked it out of the park when you described just a few minutes ago, how to justify spend in a down economy, and the fact that you need to take a long range view of some of these challenges. And when we circle back around to incentive compensation, I'm interested to hear from both of you. How do you know if your incentive compensation programs and plans are driving that ROI and that they're optimized? Maybe Chris, we'll start with you and then go to Danny.
Yeah, sure. I mean, I take a pretty practical approach to this, right? This comes up all the time. And, sometimes we find organizations trying to over optimize unnecessarily where there are other challenges in the business that they could, probably better use their time. So the first thing we always ask our customers are your plans actually delivering on the desired business outcomes? Like, is there a need to even determine whether or not there is more optimization that should take place? The other thing that's very, positive is there are benchmarks that are available to organizations to kind of level set their expectations, right? So how do my plans compare to the designs of the plans of my peers, my competitors, maybe more importantly, the companies that I aspire to be like, right? What are they doing differently from a go-to-market strategy? And is there elements of that I can implement in my design? So that's more of a forward-looking type of approach. We talked about the use of technology. There are tools out there, of course, that can leverage AI and ML. And Danny talked a lot about leveraging data to make informed decisions, right? So these tools can actually tell organizations, hey, guess what? Based on what you're trying to achieve and what the data tells us, here are ways that you can tweak your plans to, of course, optimize them. And then the other approach, obviously, is leverage experts, right? So there's Danny's team, there's our team, right? We have industry experts that have spent their entire careers helping organizations optimize their comp plans. And so that's always an avenue that organizations can go to if they want to have some, external support in figuring this out. So Danny, what are your thoughts?
I tend to look at it from the standpoint of how do you manage your investment portfolio at home? What we spend in commissions is an investment into top line performance or, some other enterprise, set of KPIs. And what we effectively want to do is make sure that we're getting the best ROI for every dollar that we're spending around commissions. And what you all too often find with sellers is their level of resilience tends to far exceed the level of resiliency that exists within the organizations they work for. So they're going to look for the shortest path to maximizing their income. And that's where you start to lose a lot of your compensation effectiveness. If you think back to that same Fortune 50 telecommunication company, one of the big comp design deficiencies we saw there is legacy sellers that were, farming their existing book of business. They were basically just writing annual price increases to achieve the vast majority of their income, and they could do it with very little effort. So when it came to actually hunting and doing the hard things, which is what the C-suite was really looking to achieve, the sellers realized it was too hard for what they were going to get in return, and they just focused all their efforts on actually the exact opposite thing that the C-suite wanted them to achieve. And so there are a ton of best practices that we employ in designing compensation plans. And, we look for some of those anti-patterns. We really look to create alignment with the enterprise strategy. We, have to look at the competency, the capability, the activity associated with the sales motions to figure out how that's working. And you can't forget that compensation is just one lever in driving sales effectiveness. The best and most sophisticated organizations are optimizing through the orchestration of what they're doing with their quota strategy, their territory design, and their comp. And so that's really where you get the most effective returns, is when all of those levers are tuned in the backdrop of what the enterprise strategy is, and then validating whether or not it's driving the right sales behaviors and responding to where and how sellers are looking to game the system. And when you start, building your muscle memory around this, full set of tools that you have at your disposal, that's when you really start to harmonize around the outcomes that matter. And it's incredible how that can drive differentiation, arguably more than product differentiation in a marketplace.
Danny, Chris, thank you so much for this chat today. We believe that this is the beginning of the conversation. So, I believe we'll be putting our contact information, making it available to all of you, and we welcome, meeting directly with you and your teams. So I will turn it over to Mike. And again, thank you all so much for your time today.
Thank you, Chris, Danny, and Jen, for sharing your knowledge and time with us. This webinar will be available for playback for up to 90 days. Simply log into worldatwork.org to access your profile, but please allow 24 hours for that playback to appear. And a quick reminder that we are going to email a short survey at the end of this event, and we highly appreciate your feedback. I'm going to stop the recording now to show the HRCI and SHRM credits. So thank you everyone for joining us. Have a great day.